Hi, this is Karen Lin. In this video, I'm going to continue from part one, talking about how to use the worksheet to consolidate the parent and subsidiaries' financial statements. NCI is present. First of all, we have the parent and the subsidiaries number copied to this worksheet. We have a debit and credit and NCI column. And when we consolidate, it is basically the parent's number plus the subsidiaries number, adding the debit side minus the credit side. Okay, the reason why I can do it, this formula is, sorry. So this formula is universal because for the credit side balances, when I'm adding the debits, I'm actually subtracting from these two numbers, right? Because these two numbers are basically, parenthesis means sort of negative. So two negative numbers adding with the positive number is actually subtracting. So two credit sides subtracting a debit side. It is easier to understand if it's a credit side balance. It would be just the parent's number plus the subsidiary's number adding the debit side minus the credit side of the adjustments. So I'm going to copy and paste these to all of my sort of accounts that has the same this number equals to the net income before, right? And this net income is calculated from the above. So dividend is the same. Ending balance is calculated from above. This number also goes to, I'm going to go one by one. So the same here, 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 here. For the investment account, we may need more, so we may subtract this and this. Okay. Goodwill, same. Okay. Total assets would be added up of the above. Okay. Retained earnings should be from the above. Okay. So I'm basically setting up my last column using a uniform formula that the consolidated number is the parents plus the sub plus or minus any adjustments to it. So if you don't have an Excel, you're calculating use manually, it is basically the parents number plus the subsidiaries number adjusting for any entries that you may be entered later. So let's start with the entries. So we start with the S entries. I started a little bit before. So I have an S entry. Let me delete it. So I have an S entry that should be eliminating the stockholders' equity of my subsidiary. So the S entry, S means stockholders' equity. So S entry consists of the beginning balance of the retained earnings, common stock, there's no APIC. So basically, common stock APIC retained earnings at the beginning would be the S entry. Now I have two S entries here. On the debit side, I need to have a credit side. In Chapter 3, my credit side of S entry would be the investment account. So I'm debiting retained earnings at the beginning of the subsidiary, debiting the common stock of the subsidiary. I'm crediting my investment account. So I'm going to do the same thing here. Okay, I'm crediting my investment account. However, I only own 80% of it. So I'm going to multiply that by the 80%. Okay, so in chapter 3, you are multiplying, you don't multiply by anything. You're just crediting the whole thing to the investment account. Now you're crediting 80% to your investment account. Where is the remaining 20%? Because if I'm doing a total of my this column, it should be the same of the credit column, right? Now it's not the same, obviously, because we only credit 80% of the 2S entries debit side added up. So the other 20% goes to the NCI at the beginning. So I'm going to copy and paste this to the NCI at the beginning. But it's no longer 80%, it's only 20% for the NCI. So the NCI shares 20%. Now, when I'm doing my debit and I'm doing my credit, they are the same, they're of the same amount, okay? That's the S entry. So for the S entry, again, it's the common stock, APIC and retained earnings at the beginning. On the debit side, when I'm crediting it, I'm adding all the debit side up together, crediting 80% of that number to investment account, 20% to the NCI account at the beginning. Okay. A entry. A means allocation, which we need to go back to our allocation table. Our allocation table shows that we have trademarks, patent, equipment, liability, and goodwill. That should be our A entry. Okay, so when I'm going back to my A entry, I look at the trademark. That is 60,000. Right, I'm adding 60,000 because it's undervalued. For my patent has a 120,000 undervaluation, but every year it amortizes 6,000. Now, when I'm doing my A entry is corresponding to the asset remaining fair value excess at the beginning of the year. So what I'm going to do here is the 120 minus 1 year of amortization, which is 6. You can see from here, 120 minus 6, because this is the second year. The A entry is only accounting for the amortization at the beginning of the current year, which means it should be only accounted for 1 year at the beginning of 2015. So that's 114. For the equipment, it's the same thing, but equipment is overvalued, so it would be the 10,000 minus the 1,000, so it's 9,000 adjustment to this under overvaluation of equipment. Finally, goodwill 25. Okay, this is my A entry. Okay, so once I settle what are the A entries would be, those are kind of my debit side, although I have a credit side, but it's basically the debit side of my entry. I'm going to credit that to my investment account. So my investment account would be these couple things. Add it up and multiply by 80%. Okay, I'm going to copy this. Okay, that's the A entry to my investment account. Correspondingly, I have an A entry corresponding to the NCI 11. That would be what I just wrote down, but only 20%. Okay, so that's 38. If you look at as an A entry, if I'm checking and the total part, I'm making my debit side equals my credit side. I entry. I means income. I entry is to eliminate the equity in subsidiaries earnings. So it equals to exactly the subsidiaries equity in subsidiaries earnings. That's my I entry. And also I'm debiting equity in subsidiaries net income. I'm crediting my investment account. So that's 64. That's my I entry. Okay. All right. D, dividend. My dividend entry corresponding to the dividend that the subsidiary paid, but it's contained in the investment account that I need to eliminate. So I'm eliminating the 50,000 multiplied by 80%. That's my D entry. Okay. So again, I have a 40. Okay, now I realize I made mistake somewhere because my investment account didn't go to zero. So I'm checking what did I do wrong. I realized that I missed the liabilities when I do my A entry. I forgot there's a liability. So there's an overvalue long-term liability, 40,000 minus 1 year amortization. That's 35,000 overvalued. So because it's overvalued, I need to debit the long-term liability for 35,000. That's my A entry. So I need to add, basically, it's on the debit side, so I need to add this. Okay. So that's 180. The same here. 0.2. That's 45. Okay, now my investment account go to zero, which means I did my SAID correctly. All right, next, let's do the E entry. E means expenses. So we go back to our allocation table. We take a look at what are the expenses that we are going to record. If there is a 6,000 corresponding to amortization expense, this is depreciation expense, this is the interest expense. So I'm going to do 6,000 depreciation, 6,000 amortization expense. That's my E entry. Interest expense, 5,000. And 1,000 depreciation expense. Okay, you can see these are the depreciation and amortization of all our fair value assets. So this 1,000 would be corresponding to my equipment 1,000. That's the E entry for equipment. For amortization 6 to patent 6. And for the 5,000, this is corresponding to my liabilities. Okay, so SAIDE. I can pretty much check whether I'm doing things correctly by comparing my consolidated number with my predicted number. Now things looks pretty good right now. Okay, so I did SAIDE. You can see that I did all my SAIDE a moment ago, but I still leave my NCI column blank. I need to do my NCI column. My NCI column basically, because my NCI account mirrors my investment account. So my investment account is eliminated by S&A entries. This is my I entry, net income minus amortization, 64,000. This is my I entry, you can see, right? 64,000, it is the net income minus the amortization, the real net income, 64. This is my D entry, right? So I assume my NCI column has similar characteristics. So corresponding to the I entry, you will see which is the NCI's share in the subsidiary's net income. How do I know this number? It should also mirrors the net income of the subsidiary 90. minus, look at the fair value excess amortization. This is 10,000, right? We need to minus the 10,000. So the subsidiary's net income minus the amortization equals to the subsidiary's real net income. Because they take too much or too little depreciation amortization, their net income numbers are off. We want to adjust them. But the NCI only owns 20%, so this is 0.2. So that's exactly 16, which is the NCI's what we predicted before. Corresponding to the D entry, the NCI also receives 20% of the dividend that paid by the subsidiary. So that is the 50,000 multiplied by 20%. Okay, that's 10,000. Okay, so we know S&A entry, if you look at the T account, S&A entry of the investment account eliminate the investment at the beginning, 828. So I'm going to show you if you add these two numbers up. I'm going to temporarily add up here. If you add these two numbers up, that's 828. Just see it? That's 828, beginning balance of investment. So S&A entry would be corresponding to the beginning balance of the investment, also the beginning balance of NCI, because NCI mirrors investment. Okay, so this would also be S&A. So I'm going to add these two up. So 207 is basically the beginning balance of the NCI. You can see it from here. It's 207. Okay, so I have a beginning balance of NCI. I have an increase of NCI because the net income attributable to it. And then I have a decrease of NCI because of the dividend received from the subsidiary. So the ending balance of NCI basically equals to the beginning balance of NCI plus the net income minus the dividend. Okay, it's very simple. So that's the 213. All right, so that should be the 213 reported in the consolidated column. Now let's check whether we did things correctly by comparing our consolidated number with the predicted number. We can see that my revenues are the both company added up. My expenses are adjusted by the fair value excess amortization. That's equal to my predicted number. Equity in net income equals to 0 because of my I entry. Consolidated number equals to my predicted number, and the parent's number, reported number, equals to the net income attributable to CI. And then my retained earnings statement basically shows, so this, okay, my retained earnings number basically shows the parent's number after I adjust it. Now look at this number. I didn't copy this number from here. It is the parent plus the, you can see the formula. It is the parent's number plus the subsidiary's number adjusted by the entries. So when I'm adjusted by my S entry, my beginning balance of retained earnings consolidated equals to exactly the parent's. Similarly, the dividend, because of the D entry and the NCI column, it equals only to the parent's number. Ending balance is calculated from the above and also carry over to the balance sheet here. Okay, I link this number to the number above. Assets, the same. Trademark, I adjusted. I add these two numbers up, adjusted by the A entry. Here for pen, it is the parent's number plus the subsidiary's number. Look at this. The A entry adjusted the fair value excess up to the beginning of 2015, which is 120 minus 1 year amortization 6. That's 114. E entry takes care of the current year's depreciation or amortization of the fair value excess of the patent, another 6. So combine A and E, this is 120 minus 6 minus another 6. So it is just 120 minus 2 of the 6. Okay? A and E combined to be the remaining fair value excess. So when you are doing the A entry, do not use 120 minus 12 because otherwise your E entry would take too much amortization from your patent. Okay, A and E combined to take care of the amortization. So I'm checking all the numbers. They look good, right? They're all the same. That means we did things correctly. To summarize, in this video, we talk about using SAIDE, and then the most important part is figure out all the SAIDE on top of what we have learned in chapter 3, plus an NCI column that shows you the beginning balance of NCI, plus the net income minus the dividend attributable to NCI gives you the ending balance of NCI. That is the portion reported in your the parent's balance sheet in the equity section. So the NCI basically appears in two places. One is in the income statement, consolidated income statement. It shows that the portion of the net income attributable to NCI, which is a subtract to the consolidation of net income to obtain the net income attributable to CI. This is the one place. The second place is in the equity section. We report the ending balance of NCI at the end of the year. That is, both of these numbers can be found from our T accounts, 213 and 16. Okay, so this is it. If you have any questions, just email me and let me know.